Okay, so the IRS just dropped a pretty big rule change for retirement. And if you're a high-income professional, you're really going to want to pay attention. This could seriously change up your saving strategy for years to come. So let's dive in and break down exactly what's happening.
So, does that sound like you? If you're over 50 and you're pulling in more than 145 grand a year, then you need to listen up. A new rule is about to fundamentally change how you save for retirement during what are probably your peak earning years. This whole thing is part of what's called the Secure 2.0 Act. Now, it's been in the works for a little while. There were a couple of delays, but the IRS has now put a firm date on it, January 1st, 2027. On that day, the rulebook for how high earners make those special catch-up contributions to their 401ks, well, it gets completely rewritten. So what is actually changing here? Before we can really get what's new, we got to quickly go over the old way of doing things. It all revolves around something called catch-up contributions.
So what are these things? It's actually pretty simple. Once you hit 50, the IRS basically gives you a green light to turbocharge your retirement savings. For 2025, on top of the regular 401k limit, you can throw in an extra $7,500. It's a really powerful way to bulk up your savings as you get closer to retirement.
And here is the absolute key. Up until now, with that extra $7,500, you had a choice. You could put it in pre-tax, which lowers your tax bill today, but you pay taxes on it when you take it out in retirement, or you could put it into a Roth account, pay the taxes on it now, and then all your withdrawals in retirement are completely tax-free. That flexibility? Well, for a certain group of people, it's about to vanish. And you might be asking, why? Well, its simple answer is it helps the government bring in more tax revenue right now.
And here's the magic number you need to remember. $145,000. If your wages from your job in the previous year were over this amount, boom, you're considered a high earner under this rule. Now, this number will go up with inflation over time, but for right now, that is the official line in the sand.
Okay, so how is this all going to work in practice? This Secure 2.0 Act actually brings in two really big changes to the rules for catch-up contributions.
Okay, so the first big change, as we've been talking about, is that high earners have to make all their catch-up contributions to a Roth account. The pre-tax option is just gone. But there's a second piece to this, and honestly, this part is pretty cool. The law also created a brand new, even bigger super catch-up limit for a very specific age group.
Let's break this down with the table here. Up top, you see the standard catch-up for people aged 50 to 59, $7,500. But check out that middle row. That's the new super catch-up I was talking about. For just 4 years, when you're between 60 and 63, you can put in an extra $11,250. That means your total 401k contribution for those years could be almost $35,000. Then, as you see in the bottom row, once you hit 64, it drops back down to the regular limit. All right, so we've got the rules, we've got the numbers, but what does this mean for your actual wallet? Let's walk through a quick case study to see the real-world trade-off here for a higher earner.
So, let's meet Sarah. Her situation is perfect for understanding this. She's over 50, she's earning well over that $145,000 threshold, and she's a super diligent saver. Right now, she loves using those pre-tax contributions to lower her current tax bill.
So, under the old rules, that extra $7,500 she puts in, it's pre-tax. That shaves about $3,400 right off her tax bill for the year. Pretty nice, right? Well, starting in 2027, that immediate tax break, it's gone. She'll have to pay tax on that money up front because it's all going into a Roth. That's the short-term pain.
But, and this is a really big but, let's look at the long game. Because the payoff is huge. If she does this for 10 years, that mandatory Roth money could easily grow to over $150,000. And here's the kicker. Every single penny of it, the money she put in and all the growth on top, is 100% tax-free when she retires. The government is basically forcing her into a really powerful long-term tax strategy.
It really brings us to a new way of thinking, which this quote captures perfectly. The game has changed. It's not just about shoveling money into an account anymore. Now it's about playing a strategic game of tax chess with your future self. It's not just how much you save, but how you save. Okay, so the clock is ticking. This rule kicks in 2027, which means you have a 2-year window right now to get your strategy in order. Let's talk about an action plan. Let's really look at this timeline because it matters. Through the end of 2025 and all of 2026, you still have the choice. You can still do the pre-tax catch-up if that's what's best for you. But 2026 is your last call, your absolute last chance for that option.
Then, on January 1st, 2027, the new mandatory Roth rule kicks in for higher earners. The time to plan is now.
So, what should you be doing, like today? Here are 3 concrete steps. First, figure out if you want to go all in on pre-tax contributions for 2025 and 2026 while you still can. Second, and I cannot stress this enough, you need to confirm that your employer's 401k plan actually has a Roth option. If it doesn't, they need to add one, or you literally might not be able to make any catch-up contributions at all. That's a huge deal. And third, take a step back and look at your entire financial picture. This isn't just a 401k thing. It's a major piece of your long-term tax puzzle.
So at the end of the day, this isn't just a small tweak. It's a fundamental shift. Retirement saving is no longer a simple transaction. It's a strategic move on this new tax chessboard. You're being asked to trade a short-term tax break for a potentially massive long-term tax advantage. So with 2 years to plan, the question is, what's your move going to be?